So that's basically the main point here. An introduction to how to set up your price action market ranges, how to not to use a stop loss and to hedge, what it means the open and close market prices, the buy and the sell market ranges, and the lots per trade when we hedge. Okay, so if you are not familiar with the concept of hedging, that is that you have to have in your trading account the possibility to open a buy and a trade transaction within the same instrument. That is to hedge. So that's very important for you to understand, to see. Let's give an example right from the MT4. This is a real account, this is an MT4. And what means to hedge is that when you enter the market into a buy price, for example, today what happened here was the interest rate of the England. So the market was into the buyers all day in the trading session. So this was the first spike of the buyers. Then the market tried to sell. They did not succeed. So they're holding their pounds. And the pound were basically still going into the buyers after now these yellow lines that you see here are the prices. So let's go ahead and first go step by step how you take advantage and how do you understand this concept that I'm mentioning here. How to set up your price action map, how to not use stop loss but to hedge, how to read the open, how to read the close, market prices, how to understand when a market range is for buyers and when it's for sellers, and of course when you trade and depending on how much you're trading with, what is recommended for you to do in terms of lot transactions. Okay. And what happened with the crisis is that we already knew with the euro and also the pound that the market was into the sellers because we were trading below the low prices of March. I hope you know that this is the key understanding of price action. When the market is below the low of March and the market started into buy pressure area, it's because we are into a crisis situation. And that means that if the market is into buy pressure area, into buy pressure like the pound and the euro, and we get through the lows of March, means that it's going to be doing a lot of new low prices. Okay. So those new low prices means that we can take advantage of the sellers, but also of the buyers, because the market is going to be interested also to take advantage of those low levels in order to buy. But we already know that the market is not giving us that buy pressure as started in March. So let me go ahead and repeat a little bit this. This is the MT4. Forget about these yellow lines and forget about this. This is the pivot point indicator. And for every single instrument, every single index that you want to trade, or commodities or FX, besides the fundamental reasons that moves those markets, we have a very important situation, which is the market areas. Okay, so the euro dollar, for example, is into buy pressure area above 110 up to the 122, 123. The sell pressure area of the euro dollar is below that is below 110 down to 105 and 104.50. This is the sell pressure, this is the buy pressure area for the euro dollar. So this year the market opened above the buy pressure area. So we knew that the common situation or the normal situation is that the euro and the pound to go up because they go on the same fluctuation of their currencies. They kind of follow each other because they go around the same fluctuation. They are on the same economic system. But then what happened? The market went below the lows of March, so we knew that things were not right. Same as dollar Canadian. Dollar Canadian started into sell pressure area, but then it went above the 130, as we all know, and it changed the market area. And now we expect the 133, which we already are there, and 135. So as you can see, it's very easy to understand the prices over the market, but the price map, once you do it, it lasts for the entire year. So we know what to expect from the euro, we know what to expect from the pound, we know what to expect from everything. So today basically is a very important day for the markets because it's into a possible recovery. We don't know if the pound dollar is going to recover the full market range after the 135, and we don't know if the euro dollar is going to recover after the 118, 119, or 120 levels. But this is what a recovery means, that the market is now picking an area, going for the buyers, holding transactions, and when they hold transactions, they generate a pressure of the market that is going to go after new highs or it's going to go after new lows. So if you want to be a scalper or a swing trader or a scalper, there's very important things you need to understand. First, that the stop loss will not help you. You must have another plan to get out of those transactions because you're facing volatility, and volatility is not a friend of the stop loss. So now the answer is, well, what do we do? And what do we do is the hedge. That is to open transactions against the main trade when we see that the volatility is going against a different price that we are entering in the market with. For example, we were here before the information was published of the interest rates of the pound in England. So we were having all buy prices here in the area. They were all to buy buyers. And then we got a lot of buyers. But what if the market was, or England decided to cut the interest rates? Well, then it was going to go back here to the lows and we're supposed to sell. Now, if you already enter in the market buying here the pound dollar, taking advantage of the interest rate, then of course, when the market turned around and it went to the low, you must what? A stop loss, it was going to activate your stop loss, but instead you could make a profit holding your buy transaction, having a sell stop, which is against the buy trade, making a profit with a sell transaction, and then if the market was supposed to continue to fall, you can still make profit just selling and then closing the buy transaction in partial lots, not entirely to take the loss, but little by little. So you have to learn, if you want to basically be a scalper or to be a swing trader, that the stop loss is not going to help you. It's not going to do any good for your account because we deal with volatility, especially when we work with high impact information like we do in Watch My Trading. We trade over US opening, and that's when most of information is published. And if you trade European opening, there's also a lot of information being published from the Eurozone. So what's important today and what's important now? What's important now is that what you see here are the moves of European session. This was basically the opening, and we are close to the closing of Europe. So you got here the close price and the open price of what? The Europe session that is about to finish. What about the US market session? Well, we have the US market session that opened here. Basically, the US actually started a little bit earlier, the moves from US, but it's around the opening here. And the high of US, it was right here. So the US market, basically, we're talking about a move that goes from here. I'm in 15 minutes now. Go from here up to here. So US, Europe. What about the closing of the market of US? The market is going to close within the next few hours. But if the market or the close prices of the market are always above the opening, this is the opening of Europe, this is the opening of US, what is all telling us is that 100% of the market is holding their trades with the pound. They're not releasing their transactions. This is called open interest too, but it's well known that when the market closes above the opening, 100% of the market is buying. The same happens for the opposite. When the market closes below the opening, the market goes for sellers. So that is a huge point that you must understand when you trade price action, when you trade market ranges, and when you after any situation that you don't know what to do because you get stuck in the market. Well, it's going to always help you whenever the market opens, when the market closes. Now, in terms of understanding the market range, so for now we know that this is the rule number one about price action. Open prices, you must understand when the market opens, and then closing prices. You must also know when the market is going to close. What are those levels? Where are those levels? Open prices of the market, closing prices of the markets. If you have the opening like this and the closing like this, 100% of the market is into buyers. At the opposite, if you have the opening prices like this, the closing prices like this, basically below the opening, 100% of the market is into sellers. Okay? And that's pretty much the first rule about price action. After that, you must understand the market range that you're going to be trading with. For example, I need to understand now if the euro and the pound, for example, if I can buy or if I can sell, or what can I do? Well, first, it's not a moment to enter in the market because the market is closing, the volume is low. So if the volume is very slow, then the market will maybe not going to give you the range that it's supposed to. So if it doesn't give you the range that it's supposed to give you, then most likely we are not going to enter into the market. Like I said, the volume is low. So the third thing that you need to understand about price action and how to trade is volume. You need volume. The best moment to trade is at the opening of the market. The first 2 hours of every opening of whatever session you want to trade, either Europe, US, could be Asia, could be any market. But the first 2 hours are key because we work with the banks. We go after the transaction of the banking system. And the banks, they don't work longer than 2 or 3 hours. After that, the market is just going to release transactions, close transactions, or hold transactions. But the main decisions are made in the first 2 hours. That's the key thing. So going towards the little rules about price action, like I said, the most important one is to understand when you are not trading in normal conditions. In normal conditions, what I mean by that is that the market is below the lows of March or above the highs of March if the market opened into sell pressure area. Okay, so that's a key point for you. All right, very important situation. So for that, you need to understand the market areas. You go to the YouTube channel and you look for market areas. Market areas, how you set up your market areas. And after this, step number 2, how to understand buy and sell prices. Okay. So, because I got many traders asking, why is the pound not going up? Why is the euro not going up? And I said, well, did you check that we are trading below March? Below March means that the entire market was releasing their transactions. They were not betting on the pound. They were not betting on the euro. But then I was like, well, that's a huge point, and they all understand that. But also, very important key thing here is that we all knew that eventually the market was going up, but we didn't know when, we didn't know which level, because for the euro it could be 114, 115, 116, 117. We didn't know which level the market was going to take in order to recover. So the euro now we have the low, which is the area of the 115 level, the 115 level. So this means that the market now is into a recovery situation. So it could go after 116, 117, 118, 119, and then getting after the 120 means normal trading conditions and how the market started it in March. All right. As you can see, I'm not using moving averages. I'm not using RSI. I'm not using Bollinger Bands. I'm not using any of these indicators that you see here or even here. And of course, the learning curve when we start to trade FX or any other market is that you start exploring many options and none of them seems to work because indicators are just a formula and they're not going to give you the right momentum to enter the market because this market gets more and more volume every day. So we must be aware of that none of the indicators are going to follow the price so fast that we can trust them. Instead, the pivot points are the tool that they will not give you the entry points or the exit point, but is going to help you to understand if the market is averaging up, is averaging down, what levels the market is averaging up to, as you can see. And for that, you go to the channel, you check the pivot points presentations. There's gotta be some presentation in English that you can use to understand pivot points. So it is huge. It is a key in order to trade over prices. So for next time, when you trade in the market and you see that the opening are down below here and the closing are here, then means that you had to pick the next buy prices. So let's go ahead and go through the market ranges. So let's go, for example, to the euro dollar. I'm just going to delete this yellow line and I'm going to go to 1 hour. So I said, okay, well then what's going on with euro right now? Well, of course the market is closing above the opening. That's it. We got the opening here and we got the closings here. Is that enough to buy? Is that enough to set up a strategy? No. What you need is to understand your first entry price, and then you need your close price, and then you need your expiration price. Okay, that's all you need. The entry price, the close price, and the expiration price. This is a strategy. This is when you set up a strategy. Entry point, the close target, and the expiration of the transaction. So if I need to set up a strategy at this moment with the euro, I have to choose a buy price that has to be above the market level. If the market level is at the 116.10.7, I need to choose a buy price that is going to go after the next level. And for that, I'm going to use the historical levels of the market. Because what that means, give me 1 second here. What that means is that we need to understand whether the market is going to go for next levels or it's going to go keep moving up or not. So you go to 1 hour, and as you can see, the historical levels here of the euro dollar, I cannot really use them because the market is coming from above to below, and they are basically hanging at the 116. But then if I put my yellow lines here, I see that it goes after 116.17, and then I have a high here in the area at the 1640. So this is my market range. And that means, and I have kind of like a middle target here in 1626. So this is the historical levels and the area with the euro dollar. And now I go back on time. I go to 15 minutes. And then I said, okay, well then, if I'm going to buy the euro, it's going to happen here, 116.17. And I know my targets now because I'm a scalper. Like I want those 7, 10, 15 pips. So I'm going to buy 16.17, and my first target will be 16.26. And if it gets through it, I'm going to hold my buy transaction after 116.40. All right, so that is the buy transactions, or that is the buy price that you can basically go after. That price, target 1, target 2. Now, talking about the expiration, well, of course, if the market gets below 116 and you're buying at 16.17, that is that you must be aware that the market may turn back around and give you sell pressure after that. So one more time, I know my buy price is 16.17, I know my exit price 16.26, I know my second target 16.40, and then I know that below 16, then that price is going to invalidate my buy transaction, because you're buying into a market range that goes from the 116 after the 116.40. This is your range. So anything below this implies that you either take the loss or you hedge with a sell stop. Let's get this example with the pound now. Over the pound dollar, same thing. The market opened here, the closing is going to be here. So 100% of the market is buying. But now I need to set up a strategy here. So your strategy, it will be like this. You need to find the buy price above the market level. We are at 132.44 now. So what will be the next buy price above the market price right now? Because you don't want to sell after this. You want to buy after this. So you go to 1 hour, you see your historical levels, and then as you can see, the market already made the targets of the 32.64 and 32.68. But that doesn't matter, because it pulls back, then means that more buyers are going to try to enter in the market. So what I'm going to do, I'm going to choose a price that is not that far, but not that close to the market price. And that gives me the 32.50, 32.52. That is a perfect buy price that it will go after the 32.68 and at the end, the 32.85. I hope you can follow me here, because if you're new with price action, this might look confusing, you may not see it, but we all start like that. We all started coming from moving averages and all those things, and then at the end of the day, we all know that it's not this that is going to give you this. It's the opposite. It's the price that's going to give you this behavior. So candlesticks, the technical analysis, all the indicators, they're pretty much trying to read this in order to predict what's going to happen here. And it's exactly the opposite. The price is what's going to give you this shape. So you keep that in your mind, and that is going to help you to go through any transaction you have hanging in your trader account. If you're new, then this is a new learning process that you have to go through. But trust me, it's easy later to understand. And once you understand it, then there's no way back to anything else, either indicators or stop loss or anything like that. So like I was saying, this is the buy price that I'm going to go after, the 132.52. This is my first target because I know the market goes after this. And then of course, here the market will try to sell again. So I said, okay, then I'm going to buy at 32.52 after 132.68. And if it breaks through this one, I'm going to keep my transaction after 132.85 and eventually 133. So once you have the historical understanding of the price action here, and you set up your strategy, you go back to 15 minutes, get back on time, and here we are. We're right here. You got your yellow line, and then you set up your line, and then you can put a buy stop, or you can just say, okay, well, here I'm going to buy. And here I'm going to close at 32.68. That's my first scalping transaction. And if you go through it, I'm going to keep my transaction after 132.85. Now, the strategy is not done there. You must know and understand what price will invalidate your transaction. Someday you said, okay, well then if it drops down to, let's say, 132, let's see what invalidates my transaction. The 32.26. So the market can move around But then I know that if it gets towards 32.39, 32.30, I'm too close for the market just drop the pound again, and they're not holding their buy transactions anymore because I'm going to be trading below this transition. And what I see below this price, what is sellers? Sellers, here is okay, but if it gets below here, as you can see, you don't have buyers any longer. You got sellers. So that is the invalidation of your buy transaction. This little price right here, the 132.31 or 132.39, 132.39. So whenever the price gets closer to these levels, then what you do is that you wait. And if the market gets below the 132.39 or 132.31, that is the moment to say, okay, then the market is not keeping the buy transactions anymore, so I just need to get out of my long trade. All right, so remember, this is your price, this is your target, you have another target up here, and this will invalidate your buy transaction. That is how a good entry transaction is done into for a scalper, swing trader, or if you have low investment to do, the best thing to do for you it is not to go long term because you need to go through a lot of things over intraday trading. So the best bet for you is to understand price because your transaction has to be fast, you have to be quick, you have to open and closing when the market gives you the target, even if it is 7 pips or 5 or 10 or whatever. Because I heard that many scalpers they go for only 5 pips, and I don't see why. If you can keep a transaction because it's gonna move up again, then why would you close it? So that's the reason why we set up a target, but also we must understand that if you break through it, it's gonna reach another target. So you don't really need to pay twice for the transaction. But there's many theories about scalping and about many other things in terms of transactions being made on intraday basis. One thing is for sure, for you to understand how the market is into a crisis, you take in consideration the prices of March. This is it. If the market opened with buy pressure, then you got the high of March, the low of March. Below the low of March is because the market is not betting on those currencies anymore. So this is a not normal situation. Better call it as a crisis. Not necessarily it could be a default of a country or the Eurozone. Not necessarily it could be any particular thing. But this means that the market is not holding transactions anymore. They're closing their trades of March. And that's a big thing because banks, institutions, hedge funds, they all get the main position of the market on the first weeks of March. I don't know if you knew that, but that's how we do it. Then later, they are going to make a take profit situation in market ranges where we see sell-off going on and all of that. It has something to do with fundamental reasons. It will too. But the main thing there is that they're closing their transactions and they're taking better prices. So always remember that fundamentals are also a huge part of the market, but the system and the banks are the ones that move the market, not the opposite, not the information. Information will not move the market, the banks, institutions. So you must understand the psychological levels where they enter and they buy whenever they're going to close. Okay, so that's a huge part of the price action. Let's take in consideration gold, for example, now. I'm going to go to gold. I'm going to see it in 1 hour. Well, we all know that gold below 1300 is into sell pressure area. Not exactly sell pressure area, but we know that below 1300, the market was going to go to the 1200. So we were around the 1300 for a long time. As you can see, the historical levels over gold, they are around the 1300 a lot. Why? Because if you trade price action, we understand that above 1300, buyers are going to enter. But if they don't keep their long transactions above 1300, gold is going to drop, and the market will choose and go after another market and leave the gold situation for sellers. And that's what happened. That is exactly what happened. They didn't make it through the 1300 for a long time. They couldn't hold it for too long, and then it dropped, and it kept dropping, never going after the 1304.37. That was the high in the area, the average high. I'm not saying the shadow of the candlestick, I'm shading the average high in the area. What is an average high is as many times as the price was touched in the area. That is the price. I never go through it. It actually consolidate, but then it went always below 1300, and the market said, okay, well then that's it. And as you can see, below 1300, the market just give sell prices. We got a very special situation here, but like I said, the average is still intact. Below 1300, sell off. And we were always waiting for sell prices, and many people ask in our Facebook, in our YouTube channel, and many other ways, is it possible to buy gold now? Is it possible to buy gold now? But the strategy with gold, it was, even if it dropped, not to buy. Instead, to wait for the price to move up and then you sell. You also need to keep in your mind the strategy that you're going to go after. That's going to save you not just a lot of money, but also a lot of stress. Because of course, many people are like, well, my indicators are telling me I can buy here. My indicators are telling me I can buy here with gold, or I can actually buy here. And I will say, sure, you can go ahead and buy. If you want to do an intraday session, I don't think that's going to help you a lot. And if I were you, I would go for the sellers. I will wait for the market to go up, and then I wait for the pullback, and then I sell. I don't see a point buying below 1300, knowing that the market range below 1300 goes to 1200. So, many things like that, when you set up the price map in your whatever instrument you want to trade, I go to the DAX next, then it's going to save you, like I said, a lot of stress over transactions. If I go to gold now and I put in 1 hour, I see that the market is gaining momentum. Yes, it is. But it's gaining momentum towards what? Sellers. We got sellers here. We got also sellers here. We got sellers here. And am I going to sell here? No, I'm not going to sell here. I'm going to wait for the best sell price I have. It could be this one, right? But I'm not going to sell if the market closes above the opening, because it could go after the next sell price, which is right here, or the next sell, which is right here. And they also sell here, and they also sell here. So they sell in many different prices. So if the market drops then and it gets, let's say here, then of course you can sell close to the low area. This is the low prices. But if it keeps giving you buy pressure, then you're not going to sell. You wait for the next sell price. But to buy, when you see that you are below 1300 and the market has all the possibilities to go after the 1200, then a buy transaction could give you a lot of headache, right? So the pound, yes, the market is going into the buyers, also the euro. The dollar yen is below 110 now, and the below 110 is for sellers. So now dollar yen should drop down to 109.82, 109.70, 109.58. But if it gets to the 110, the buy pressure will go for the buyers, and it can take the price up to here. So dollar yen is into better called a transition. The 110 buyers, below the 110 sellers, and you got all these targets to move down to. Okay, so like I said, this is only an introduction for how to trade into a crisis, understanding the low and the highs of March, and also how to understand the market range. But this is just an introduction. If you want to dig into this because you're coming from indicators or you're coming from any other strategy, then this is the great start point for you to go for the price action. Because I know it's a new thing for many. Like it was a new thing for me when I started it. Like 10 years ago, I was training with moving averages. I was training with, and I lost a lot of money using stop loss. After I sat down with coaches using price action in New York, then that was the beginning of my career. So I really hope this can help you and get you out of any unuseful strategy, any unuseful things that you've been trying to. Okay. And of course, one of the most important things is to pick your broker correctly because there are many brokers out there and many things going on right now. So to choose your partner is a huge point. Is the key, and that's the beginning of your success. Because if you are into the wrong partner, because they are actually your partner, because they want, if you want to win, they want you to win too. If they don't want to win, then they're going to make you lose your account. Okay. So I really hope this can help you. This little presentation, like I said, is going to be available on the YouTube channel, so you can go ahead and then go through things there, because I know this. If you're new in price action, this is a lot to to understand and to learn. But it could be your beginning, and I really hope that we can be in touch in the future, and I can help you to be a better trader and to take care of your account. Because, like I said, I've been through many like very bad decisions, not only strategies but also bad brokers. Okay, so the main thing is for you to choose the right one and then to apply the strategy that is most useful for you. It's been a pleasure. Thank you so much.